Hello guys, we'll start with new topic today, that is IND AS 21 effects of changes in foreign exchange rate. IND AS 21 effect of changes in foreign exchange rate. It should be there in your page number 199 in your main booklet. Did you find that? Yeah, sure. 199, correct. Double century ಒಂದೇ run ಬಾಕಿ. Can be? You studied this as accounting standard 11 in your CA Inter. Correct? No? More or less same with few extra components and few terminology changes. Okay, so first, what is the objective of this standard? Meaning why the standard is there? This standard is trying to cover two things. One, if you have any foreign currency transaction, let's say you sold the goods to a foreign debtor or you purchased the goods from a foreign creditor, correct? How should you account that in your books? Because the currency will be different. Suppose you are in India, let's say you are following rupee accounting. You are showing all the components in rupees. Okay, you purchased some goods in dollars. Can you show that in dollars straight away, or you have to convert? Convert means you have to use an exchange rate. What exchange rate should be used? Because exchange rates keeps fluctuating. Which rate should be used? For that one purpose, this particular standard is there. So if you have any foreign currency activities or foreign currency transaction, how it should be recorded in your books? Second main thing is, what if you have any foreign operations? Meaning, what if you have any subsidiary? What if you have any branch, joint venture or associate? Not in your country, but in someone else's country. Correct? If you have a foreign subsidiary basically, or a foreign joint venture, how because you have to consolidate. Subsidiary means you have to consolidate. Joint venture means you have to use either equity method of consolidation. Correct? So, but that their value is in probably dollars or some other currency, but our value may be in rupees. How should we add them up? What are the things we need to consider is what this particular standard is trying to cover. Fair enough? What if you have foreign operations? What if you have foreign transactions? That's all it's trying to cover. Nothing else. Are we okay? Before we start with the problems, let's go over a few things or few pointers or few definitions that's going to come in our problems. First one is foreign currency. What do we mean by foreign currency? Foreign currency means any currency other than functional currency. What did I say? Foreign currency means any currency other than functional currency. Have you heard this term functional currency in your AS11? AS11 didn't have this. They only had foreign currency. Correct? No. And local currency and foreign currency. They work like this. IND AS, as far as IND AS is concerned, there are three types of currency you will get. Foreign currency, functional currency, presentation currency. Okay, now three will be, I'll tell you what all of them, each of them are. But first, one we saw, foreign currency, which we'll call it as FC going forward. Okay, foreign currency means what? Any currency other than functional currency. They have not defined what is foreign currency. They have defined functional currency and saying anything other than functional currency is a foreign currency, like that. Functional currency, we'll call it as FLC. Anything other than FLC is an FC. Okay, now the most important one, which is what? Functional currency. What do we mean by functional currency? Is the funda, correct? No. Functional currency, I'll tell you the actual definition and then I'll simplify for you. Functional currency is a currency functional currency is a currency of primary economic environment under which the entity operates. It's a currency of primary economic environment under which the entity operates. Ideally, I would say remember this word. It's a currency of primary economic environment under which the entity operates. Anything went in? No? Anything went into your head?
Operates
that economy. So suppose they're operating in 10 economies. They're transacting with 10 different countries. They're transacting with US also, they're transacting with UK also, they're transacting with Japan, China, like this, they're transacting with many countries. A particular company in India is transacting with 10 different companies situated in 10 different countries. Correct? So which economy we should consider now?
From India only everything is going.
From India only everything is going. So Indian economy is what you're saying. Huh? Okay. Unfortunately, standard doesn't agree with you. Okay, first point, let me make it very clear. Just because you are in India does not mean your functional currency is rupees. Take that out of your head first. I think AS11, you always had that one thing in mind. Correct? No. INR is my local currency. Anything other than INR is a foreign currency. That's how you used to do your accounting, correct? Take that first pointer out from your head. Just because you are in India does not mean your functional currency in rupees. That means even Indian companies can have functional currency other than INR. Very much yes. I'll tell you in a bit. Take this out. I'll give you an example for that. Is it okay? Now, simple. Here they use bhari words, in definition.
Yeah.
Simple term for this functional currency is a currency for which your heart beats, for which you are concerned about. Which currency you are concerned about is your functional currency. So what does that mean? That I'll tell you more when we go for definitions. More factors, there's some indicators. Is it okay? Are we okay? Or I'll give you an example now only. Better maybe. Okay, functional currency. We're looking at FLC. What did I say? In simple term, it's a currency for which we are concerned about. Correct? Now that's our pet name. Don't write this in examiner. So which currency we are concerned about? That currency is functional currency. I said yes, no.
Yeah.
Okay, let me give you a small example for that. Now I'm teaching for CA final students. My CA final students, let's say all of them are in India.
Okay.
That means all of them will pay me fees.
Yeah.
Yes, no, sir.
Yeah.
Okay. Do you think they're going to pay me dollar fees or they're going to pay me in rupees?
Rupees.
They're going to pay me in rupees only. Correct? No, INR. Fine. Now let's take a simple example that all my students are in India. Okay, and I'm teaching CA final subject, FR subject I'm teaching, and for that they are, let's say they've taken online coaching, and let's say they're paying some rupees, some value in INR they're paying me. Okay, now. Now, dollar is becoming strong. Dollar value is increasing. Earlier it was 75 at the beginning of the year. Now it became 80. Or when I started FR coaching, it was 75. 2 months over, it became 80. You tell me, am I concerned about dollar ka fluctuation now? All my activities are in INR, sir. To do online coaching, I require setup, I require iPad, iPens, studio and all this stuff. All this expenditure. I buy the equipment, I incur my expenditure. All my expenditure is in rupees. All my revenue is in rupees. All my investment is also in rupees. Fair enough, this is my setup. Fair enough, because I don't do any activities outside India. Fine now. So now you tell me, $1 was 75 when I started FR coaching, but when I ended it became 80. Am I really concerned about it now? As a citizen, I might be concerned. Oh, what is happening to Indian economy? Yeah, like this, big dialogue will give. Correct? But financially, am I bothered or am I in a safe zone? I'm safe zone. Correct? Now, because I don't have any dollar dealing. Correct? Now you tell me which currency I am concerned about. INR. Correct? No? That means INR is your functional currency. That's what is a functional currency we said. The currency which the entity is concerned about. That is functional currency. Yes, sir. Correct? Taking the same example. Just with slight modification. Okay. Now, I am not teaching CA final students. I am teaching US CPA students. Okay. Now, I buy all my equipments from US in dollars. For today, to do the studio setup, I hire a few people. To them also, I'll make the payment in dollars. I'll collect the money from students. Students also pay me in dollars through a PayPal account or whatever it is. Correct? So that means now all my dealing is in dollars. Let's say rental and all these expenses. Since I'm operating in India, there's some small rental expenditure I need to incur. That petty, small expenses I'll incur in rupees. Okay, small portion of my expenses in rupees. Otherwise, all my funding, investment, receipts, expenditure, most of my expenditure are in dollars. Are we okay? But I'm an Indian entity. I've registered in India. Okay. Now you tell me which currency am I bothered about now? Am I really concerned about INR? Now will I be chilled out? When I started FR, when I started the coaching, it was 75. $1. Okay. Now it is becoming 80. Now you tell me honestly, which currency am I concerned about now? Dollar or INR? Dollar. That means what? Dollar becomes or US dollars becomes my functional currency. Correct? But an Indian entity. But it is having what as functional currency? Dollars. Fair enough. Is it okay? So point I wanted to prove by this example is just because you are in India does not mean your functional currency has to be INR. It could be other also. Fair enough, huh? Case to case basis you have to analyze. Okay, there's no one common answer for this. You'll have to keep all the facts into consideration and then conclude what is functional currency. Because for most of the company, it will not be one-way traffic. Some expenses will be in dollars, some will be INR. Okay, it will be chow bath kind of scenario. You'll have to go case by case basis and analyze, dig out. Fair enough. So here, as per the books, I can give you the answer. Now, practically, you'll have to go a little more deeper. Substance over form, you'll have to apply. Got it, huh? Yes.
So,
the
what happens to the other example where you told some to Japan, some to UK, some to US?
We'll go for that. Don't worry about that. We just started the topic. So he's asking, sir, if you're dealing with 10 different countries, if you're teaching for 10 different courses across 10 different countries, what to do? We'll see into that. Okay, there are some indicators. Okay, you can't have 10 different functional currency. Functional currency will be one. Okay, rare circumstance you can have more than one functional currency. I'll tell you in those circumstances, not for the time being. But general rule is one company, one entity means one functional currency. Okay, I'll tell you a small exception for that. But for the time being, just remember that one entity means one functional currency. So if you're dealing with many currency, you have to look at certain factors. They've given some indicators. You have to check that indicator and accordingly conclude which among those 10 currencies is a functional currency. We're going to do that. We first set of problems is that only. Are we okay? But just now we only looked at the meaning. Correct? So functional currency means what? Actual definition is it's a currency of primary economic environment under which the entity operates. Our pet name is what? The currency which we are concerned about. As simple as that. Okay? This is a pet name. Yeah.
So, like if there is a subsidiary of a US company in India.
Don't worry about subsidiary and all. We have a question. You remember when we did consolidation? What did I say? We will not do foreign subsidiary now. One time will come. Okay, that time we will do foreign subsidiary. We have problem. Okay, maybe your doubt will get sorted there. Wait for the time being. Okay, or okay, maybe since you started. Now I'll see if it gets sorted. I'll not answer it.
So all their receivables are in USD. Then all their payables, vendors, everything is in India. Employees, everything is in India. Only receivable 100% is in USD. So
repeat the question. Repeat the question.
So I mean, I'm a company my parent company is in US. So I'm a cost plus entity who makes services and give to the US, and then I get money from US. So 100% everything comes from US. And all my vendors, all my employees, everybody
normal occurrence. Then now functional currency is US dollar or INR. Functional currency, that's the question. Yeah, we are not yet gone to the indicators. Okay, so this is a pet name. Don't apply pet name and directly conclude. There are 4 indicators are there to determine what is functional currency. We'll test that. First, we'll know what it is. Then conclude. Okay, case to case basis, it will vary. I can't give you one answer. As per books, I'll give you one answer. Practically, you'll have to look at more facts here. Fair enough, it could be a subjective because dealings with the company we have equal weightage. As per books, we put one over the other and conclude. Practically, it may be other way around also. Fair enough. So as per books, I can give you an answer here. Practically, you'll have to just analyze a little more. Fine. So I'll not answer that for the time being because you have to tell you the indicators. If some indicators are there to identify functional currency. We have not yet discussed that. We only look at the meaning. Fine. So did we understand this now?
Yeah.
All right. That means we'll go back to the first definition. What is the first definition, Vishal? What is a foreign currency? Anything other than functional currency is a foreign currency. In my first case, INR was my functional currency. So if I'm dealing with any currency other than INR, that is a foreign currency for me. But in the second case, where I was teaching US CPA students, what is my functional currency we concluded? Dollar. So anything other than dollar becomes my foreign currency. Like that. Okay? That is the functional currency. Well, you want to write this down or okay? Fine, no? Okay. Move on to the next. I said one more will come, no? That is presentation currency, which we're going to call it as PC. Sir, you think logically now. There is a company in India. They concluded that their functional currency is dollars because they are bothered about dollars. This company means they have to follow Companies Act 2013 ka rules. Maybe they'll have to get their books done, audited and all. Tax audit if necessary. Correct? Yeah. Can you give the auditor a dollar statement and say, hey, macha madu? Or can you give it to the income tax authority, hey, take dollar statement. My functional currency is dollar. Can you give it to ROC, dollar wala financial statements, or what will they say? Convert and give it to me in INR. Yes or no? Yeah. Correct? So that is your presentation currency. Presentation currency means the currency in which you have to prepare the financial statements due to the regulations. Got it? Fair enough? Every Indian company has to prepare financial statements in presentation currency. Fair enough? But how the accounting will reflect, we'll see later. Okay? Why is functional currency required then? Because assets, liabilities, income, expenditures are measured at functional currency. Fair enough. Accounting is kept by keeping functional currency in mind. You do the accounting, but you account it at presentation currency like this. Fair enough. You maintain your records in functional currency, convert it later into presentation currency, and give it to the auditors, ROC, etc., etc. Fair enough. Like that. So hence, 3 types of currency will be seen in this particular problem. Okay. Foreign currency, functional currency, presentation currency. Last, did we get it? Presentation currency means simply the currency in which financial statements are prepared and presented, whoever that is. Okay. Alright. Next is foreign operations. Foreign operations. Again, another important definition. Foreign operations means any branch, any subsidiary, any associate, or any joint venture. Okay. Situated or whose activity is conducted in either in a country or in a currency other than that of reporting entity. 2 points I said there. Foreign operations, first of all, means what? It means either a branch or subsidiary or joint venture or associates. Okay. This particular entity ka activities is either done in a country or it is done in a currency other than that of reporting entity. Reporting entity means the main company which we're concerned about. Okay. Are we okay, sir? Following up? Yeah. Let's say like reporting entity is A Limited now. The main company is A Limited. They have a branch or they have a subsidiary known as B Limited. Okay. When can you call the subsidiary as a foreign operation? They have A Limited and A Limited has a subsidiary B Limited. Okay. When can you call B Limited as a foreign operation? If B Limited ka operations or activities are either done in a country other than that of A Limited or done in a currency other than that of A Limited. Let's say A Limited is in India. If B Limited is there in US, that means what? B activities will be done in US. So you can treat it as a foreign operations. Fine. No. Okay. Sir, we understood country, sir. What is this currency? Correct. No, this is okay. No. If you have country is very much, it's okay. If you have a branch in US, correct? Or if you have a subsidiary in US, automatically it is what? A foreign operations. But they didn't define foreign operations like this. They said foreign operation means what? These things, okay, these entities, but their activity should be done either in a country or in a currency other than that of reporting entity. Correct? No? Like, let's say, main company is A Limited. Their functional currency is INR. Can I write FLC now? Their functional currency is INR. Alright? They have a branch, sir. They have a branch. Branch is in India only. Branch is in India only. But what this branch does is, they are concerned about 100% exports. Fair enough. They develop a software and export that 100% software. They never sell in India. Okay? All their engineers, they hire from on-site only. They hire the engineers and let's say they pay them in dollars only. Fair enough. Their receipts, their payments, most of their receipts and payments are in dollars. Except maybe small expenses like building rent and all, they pay it in rupees. Because to landlord you can't pay in dollars, no? Landlord will say give me rupees only. Small expenditure, we are giving it in rupees. Otherwise, most of our expenses is in dollars. Okay? US dollars. Now tell me, what is this branch? Branch is concerned about which currency now? INR or US dollars? USD. So functional currency for this is US dollars? Yeah. Correct? But is this branch outside India or within India only? Within India only. Correct? That means what? Same entity. Correct? It's not a separate entity. It's a branch. But they're having 2 functional currency. I remember there's an exception. This is what they mean by that. So it's a branch. Correct? And the branch activities are conducted outside India or within India? Within India. But in a currency other than that of reporting entity. Because currency of A Limited is INR. Currency of this is US dollars. Yes or no? Even this could be considered as a foreign operations. Yeah. Yes. Yeah. So now, can they present separate financial statements or it has to be merged? That means all this branch is maintaining their, let's say they're maintaining their records in dollars. From dollars, we have to convert into rupees. Yeah. So we'll have to use some exchange rate. For that, we will not go for the time being because we are still at the definition stage, not at the conversion stage. Conversion will only come later. But did you understand that even foreign operations could also be there in the same country, provided their activities are conducted in a different currency other than that of main entity? Possible. In this case, there will be a hiccup that what? same company, one company only, correct, is having multiple functional currencies. But otherwise, general thumb rule is one entity, one functional currency. Got it? In this case, what to do, we'll see later. Accounting person. Don't worry about accounting person. Again, here, don't overthink. Whatever I'm saying right now, stick to that only. Accounting, everything will come. We have more than almost 20 problems or something we are solving. Okay? Full accounting is also there. Consolidation also we will do. Don't worry. Fine, end to end. That also will be taken care of. We'll start slow, but so since it's a new thing, so let's learn everything in the class slowly. Okay, so spot rate and all is fine. Closing rate is fine. We know that. Closing rate means what, sir?
The closing balance sheet date.
Balance sheet date. The reporting date, basically. Fair enough, whichever. If you're preparing interim financial statements, the interim closing date will be a closing rate. We'll see what is the significance of this later. All this spot and all closing rate is for conversion. Let's not bother about that for the time being. We'll see that in the problem. So did you understand this so far? So this is the definition. So from the definition we made out that now we'll have to keep in our mind three things: foreign currency, functional currency, presentation currency. Presentation currency you can sideline for the reporting purpose. It is correct. No, the main thing we are bothered about is functional currency, foreign currency. Are we okay? Any confusion or good enough? Good. Oh, going a little bit is going in or okay? Or already early morning already bound, sir? Going in. Okay. So next they have given exclusion, sir. You need not apply IND AS 21 for few things. We already know this. One is for derivative transaction, which is covered by IND AS 109. You already did a derivative, no, sir? Correct? There did we even bother about IND AS 21 exchange rate and all? We started doing on our own there. Yes? Because IND AS 109 gave the treatment for that. Yes? So for derivative accounting, do that. For hedge accounting also, you don't have to follow IND AS 21, you follow IND AS 109. You remember hedge, cash flow hedge, fair value hedge of net investment in foreign operations. Like this, we did hedge accounting. So if you're following hedge accounting, IND AS 21 whatever provision is there is not applicable for you. You do what you did in hedge accounting only. I'll once again repeat what is how hedge accounting affects. I'll repeat it so that we can test our memory. For the time being, know that for derivative and hedge accounting, it is not applicable. And this is one specific case. This was there in your IPCC also as para 46A exemption of AS 11. Question was also there. I don't know whether you remember. I'll repeat this. Long-term foreign currency items for which entity has opted for exemption under IND AS 101. If you had any long-term loan, you remember this in your AS 11, you had done this. I'll repeat the problem. See if it makes sense to you. It was there in your study material. If you are IPCC ka study material or CA Inter ka, if you had taken a long-term foreign currency loan and that loan is used to buy a PP, meaning fixed assets, correct? Then the exchange fluctuation on that monetary, on that loan, you didn't transfer to P&L. There was two options given. Either you can transfer to P&L or you can add the exchange fluctuation to cost of the asset. You could have used para 46 exemption. I don't know. Problem was there in your study material. I don't know whether you did it or you remember doing it now. Okay. So if you were adopting adding the exchange fluctuation to PP using para 46 exemption of AS, accounting standard, same you can follow in IND AS. After IND AS applicable for you, same thing you can continue. This is carve out. This is carve out. This is not there in IFRS. This is only India has this. Whatever you're following in AS accounting standard, the same treatment can be followed under IND AS also. Only for one thing, that is long-term foreign currency items. Okay. Again, I'll do it in a chart and tell you what this is. And when you're doing IND AS 1, I think we may come across the problem also. Here, theory part I'm going to explain. Manageable. Just remember for the time being that these...
Every year the cost of the asset will change.
Cost will change. Correct. You did it in PP. I mean, if you remember, I don't know. You don't really seem to remember. It was there in your study material. No worries. Maybe they amended it. I don't know when you wrote your CA Inter. Because earlier AS 10 it was not there. Only the revised AS 10 this particular question was there. No problem. Anyways, so it doesn't matter. Anyway, we're going to look at it here. Is it okay? This is just one AS wala benefit is given. Whatever you're doing in accounting standard, you can same thing you can continue and continue to do the same in IND AS also. This one carve out. Meaning it is in IFRS, this option is not there. But India has given this option, hence we call it as carve out. Sorry, na? Now we're going to go a little more into functional currency. Anything you want to write down? Okay, finished off. Finished. Okay. Functional currency. Functional currency means it's a currency of primary economic environment under which you operate, or which we said currency which we are concerned about. Correct? Okay. So now they are saying how to identify functional currency. First of all, why should we identify functional currencies? Assets, liability, equity, income, and expense is measured in functional currency. An entity measures all its components of financial statements in functional currency. Okay. Hence, we require functional currency. This is very important to us. Because basically, measurement of all these components is done in functional currency means you have to know what is functional currency. Yes, no? Now, how to identify functional currency? They have given you 4 parameters or 4 indicators. 2 are primary indicators, 2 are secondary indicators. Okay? So, you have to check those and accordingly conclude what is functional currency for you. First primary or first of the 2 primary criteria, this condition is identify the currency. It means functional currency means the currency in which sales are denoted. Maybe I'll write it in the next page. FLC conditions. They have given the indicators. These are not conditions. These are indicators. Okay. Indicators means all may be satisfied, some may be satisfied. Again, as I said, no, this requires sufficient prudence or judgment in determining FLC. Practically, that's what I said. Books may say we can conclude something, but practically the answer may be slightly off, may be different. So these are indicators. Following factors may be considered in determining appropriate functional currency. May be considered. Indicators, not conditions. Maybe all the 4 may be satisfied in some, only 3 may be satisfied, 1 may be satisfied. You have to take a case-to-case wala call here. This is totally up to the management ka judgment and auditor ka convincing power there. Fine, becomes there. Alright? Doesn't mean that it's totally ambiguous, but they have defined because it is not possible to satisfy all the 4. The indicators are such that all the 4 cannot be satisfied at all point of time. Very, very rare. Hence, they have not given it as a condition, but just as an indicator. Okay, now? First, can I move on? Yeah. First indicator is functional currency is a currency in which your sales are made. Basically, the billings you will make, no? In which currency you send the bill, which currency you denote your invoices, that becomes your functional currency. First is that. Okay, first parameter is a sale. Okay, under sales, one more is there. Which economic factors or which country's economic factors or competition factors, which countries' competitive factors and regulation affect selling price. 2 things you have to consider here. Basically, in which currencies your sales are denoted and which country ka competition forces and regulation affects the determination of selling price. Or maybe we'll take it as a case. First, know this. Write it or it's there anyway. I'm just summarizing. Okay. This is the first primary indicator. Okay, now. First primary indicator is with respect to sales. Second primary indicator is with respect to cost. So functional currency means the currency in which direct material, labor and other cost are incurred. Or maybe you can simply write currency in which cost is incurred. Currency in which direct material, direct labor and other cost are incurred. In which currency you are incurring the cost, that currency becomes your functional currency is what they are saying. And why do you incur the cost? To provide goods or service. Maybe that also you can write. To provide goods or service. To provide goods or service only you incur cost, no? To provide this goods or service, check in which currency are you incurring the cost. That currency becomes your functional currency. One is with respect to sales, another one is with respect to cost. Can I simply say functional currency means the currency in which sales are denoted, the currency in which cost is incurred. Can I simply say that also? These 2 are primary indicators, main indicators. Primary indicators. We have 2 more conditions or 2 more indicators. One is funding currency. Funding currency means the currency in which you raise your finance. The currency in which you issued your equity shares, debentures, preference shares. Okay. So in which currency are you raising the funds for? That becomes your functional currency. Got it? No. Fourth one is operate or investment currency. Investment currency. The currency in which you make your investments or you retain your investments. That's what they will say, like, it's a currency in which operating receipts are retained. That is nothing but investment currency. Alright? So these two are secondary indicators. Fair enough. These are the points you will keep in mind in determining what is the functional currency of a particular entity. Yes, sir. It's given, sir. I think it's given. I just made a short pointer. That's it.
So funding and
funding currency. The currency in which you raise your finance. The currency in which you will issue equity shares and all for funds, no, sir. Check in which currency are you giving equity shares or preference shares or debentures or bank loan. Fair enough. In which currency are you raising your money to finance your activities? That currency becomes your functional currency.
If the investors are foreign who gives USD, but then
that's what
our equity shares denoted in INR.
But again, you'll have to just check how are you repaying that.
They're not repaying, no equity.
How are you giving the dividend? If you're saying like it becomes totally. If let's say if your 100% FDI is allowed in that particular sector, then you'll have to take a call. Fair enough. Let's say you received it in dollars. All your activities are also in dollars. Then functional currency could be dollars. Fair enough. Like that. Just because you have received the fund, it can't be in dollars. It does not mean that your dollar is your functional currency. I told this is a secondary indicator. I didn't tell it is condition. It is just an indicator, and that too secondary indicator. That means what? First preference to these two. Correct? No.
Yeah.
Then to this. Correct? So you'll have to take a case-to-case call there. One way of just looking at the funding, you can't directly conclude. That's the reason I'm saying all the factors you need to take into consideration and then only conclude what is a functional currency. Don't test it individually one-on-one. You'll get a lot. It is not determined like that, and it will lead to a lot of confusion also. Test all the four. Okay. Keep in mind all the four. Okay. In some cases, all the four will be satisfied. Some only one or two. Then you'll have to take a case to call. One will have a trump over the other. That you have to identify by case. Don't just make a general case of it and apply it. I'll tell you, we'll go through 4 questions now. Then there you will probably get to know how to identify. I know. Yeah. So don't take individual. Don't isolate them and test. That will not work. Fine. Don't separate one of them and test for them. It will not work.
How can we really say investment is having more?
That's what. Don't worry about that. We have not even got to the case now. We'll see the case. These are indicators, sir. Don't confuse indicator with a condition. This is not a condition. Fine. We have all this. You check. It's a case-to-case call. That's what I'm repeating. Whatever we're doing in books may not necessarily be the case. I'm repeating that. No? Fine. So you'll have to just take. In the books, they will give you a particular case with particular information. But practically, that information might change. Yeah. Correct? Weightage. So you'll have to assess it differently. It's a judgment call totally. But you can't leave it totally to judgment. There must be some parameters to judge something also. No? They've given the parameters. Fair enough. Those parameters is applied as a case study here. Have a little open mind here. Fair enough. So yes. So don't isolate them. That's what I'm trying to say. Got it? So can we repeat this once? Yeah. Functional. To identify which is a functional currency, we look at 4 indicators. First 2 are the primary indicators. What are the first 2? First is the sales. The currency in which your sales are denoted. Not only that. And check which competition and which regulation, which country ka competition and which country ka regulation is affecting the selling price for you. Check both. Selling price is denoted in which currency and which country ka competition and regulation is affecting that selling price. That is a joint together. Okay, condition. Second, check in which currency are you incurring the cost to give the goods or service, like material, labor and other cost here that you are incurring. No, check in which currency are you incurring. Those 2 are primary indicators. Fair enough. Then we have 2 secondary indicators. That is, in which currency are you raising the finance? And in which currency are you making the investment? Or rather, in which currency are you retaining the receipts? Retaining the receipts means investment only, in a way. If you put it in bank or bank deposit also, it's an investment only, correct? That's what they will say. Instead of investment currency, they will use the word, the currency in which operating receipts are retained. Fair enough. I could say that you can interpret that to be investment currency. Got it? Now, these we will check and accordingly conclude in each case what is a functional currency. Can we get to that particular part? Any confusion? Go. Okay. Maybe what I can do is, hang on, let me take up the next question. Okay, actually we'll do question number 1 first. Come to question number 1, sir. In your book, there's actually some more. Okay, here. First we'll do question number 1 and then I'll do the circle portion. Let's come to question number 1 first. Future Limited sells revitalizing energy drink that is sold throughout the world. So there is a particular energy drink which we are selling throughout the world, okay? Sales of the energy drink comprise of 90% of the revenue of Future Group. I mean, this Future Group has many products. Among this energy drink constitutes about 90% of the revenue. And that is sold throughout the world, correct? No? For the convenience, underline that word. For the convenience and consistency in pricing, sales are denominated in US dollars. For the sake of convenience, and consistency, we are denoting the energy, we are billing it in dollars, correct? All the finance activities of Future Limited is in local currency, that is L dollars. Although the company holds some USD cash reserve. Some USD reserves they have just for emergency sake, okay? But most of their finance activities, what currency, sir? Local dollars. Okay, almost all the costs incurred by Future Limited are denominated in local dollars. What is functional currency for this Future Limited? Did they say, like, though the sales may be in dollars here, correct? But is it really a mandate? Are we driven by the dollar now, or it's for the sake of convenience, they said? But you are concerned about this company is concerned about which currency now? Their finance activity is in local dollars. Their cost is in local dollars. Only for the sake of convenience, they're billing it in dollars. Yes, no? That means what is really the currency they're concerned about now? Local dollars. Correct? That means what is functional currency? Local dollars is the functional currency of this particular company. Got it? Like this, you'll have to analyze case to case basis. Understood? Manageable? How will you write this in the examination? First, you'll write these 4 indicators. And then what will you write? In the present case, though the billing is in dollar, it is just for the sake of convenience. But all the cost and finance activities of this particular company is in local currency. Hence, the primary economic environment in which this company is operating is local dollar. Or rather, the functional currency for this company is local dollars. I'll give the answer or okay.
Okay, sir.
Fine, got it? Same thing they've given here also. Manageable? First write the indicators and just write the same points what is given here and conclude. Conclusion is local dollar is a functional currency.
Okay.
Confusion idea munduku hogboda.
So, but sales are made in
for the sake of convenience, because you're selling it throughout the world, no? Okay, for the billing per se, for it to be a convenient sake, they're billing it in dollars. But are they really concerned about dollars? They only for the sake of convenience and consistency in pricing.
If they're selling in dollars, now they'll be concerned about dollar rates, no?
They're selling throughout the world, no?
Yeah, but
think from the hedging perspective. If they start billing in each currency, they are exposed to a lot of foreign currency risk here. If they sell in European market and say bill it in euro, if they go for Japanese market and sell it in Japan yen, they're exposed to too many foreign currency market. Yes or no? That means you have to get into too much of hedging instrument to cover your risk.
Yeah.
Correct or no? To cover that hedging risk or to avoid that so much drama, they said I will bill it in dollars and I only cover my dollar risk. Fair enough. So that it'll be easy for me. So that is their intention. That's what they mean by convenience and consistency. Obviously, like that way, if they are concerned, obviously they're billing in dollars means they're concerned about dollar recovery. But they are not interested in the dollar value. Actually, they're more interested in the INR value after conversion. So actually their mind is running towards INR. Fair enough. So that is what they're trying to say there. To cover that hedging risk, they are billing it in dollars. That's what they mean by convenience and consistency. Artha like this. See? Okay. Manageable? Sure, no? Move on to the next. Okay, question number 2 go na? Actually, before question number 2, I'll have to tell you a pointer. Then only I can go for the further. Okay, we saw the 4 indicators of functional currency, sir.
Yes.
We also learned what is foreign currency. We also learned what is a foreign operation rather.
Yeah.
Okay, now there is a small pointer here. Okay, you need to know this. Then only we can solve the next case. A Limited is a parent company. They have a subsidiary called B Inc. Which is there in US. Fair enough? Are we okay? Now, A Limited, they've concluded that INR is functional currency. Functional currency for A Limited is INR. Okay. Now dollar B Limited, since it is there in US, it will present the financial statement in dollars. Yes or no?
Yeah.
Does it mean its functional currency also should be dollars, or it could be different? Could be different. That's what we learned in a previous example. Yes, no? Just because you're operating in a particular country does not mean functional currency and presentation currency are same. They could be different. Yes.
Yeah.
Now we are trying to identify when can you say this A Limited, can I call it as reporting entity, no?
Yeah.
Main company, and this is a foreign operation. Okay, when can you say reporting entity and foreign operation ka functional currency is same? And when can you say that they are different? Okay, this you learnt it in your IPCC as integral foreign operation and a non-integral foreign operation. Napka barta idya? No, okay, no problem. Okay, you learnt it like that. IND AS does not use the word integral and non-integral. Okay, anyway, this much, is it okay for you?
Yeah.
Here there is one company in India, parent, there, that is a reporting entity. Their functional currency is INR. Now we are trying to determine whether functional currency of B also is INR or something else. There are certain factors for that. If factors are determined means then B also, if conditions are satisfied means B ka functional currency also will be INR. Otherwise it will not be. Is it okay? Yes sir.
Yeah.
Okay. So we are trying to determine, or you can write the conditions. They have anyway given it here, okay? Here only it is there. You remember this para? Before this question, this para is there. That is what I'm writing, but trying to kind of summarize it for you. That's all. What I'm going to write is conditions to be fulfilled. One moment. Should I have or just conditions, and I will take it as factors only. Factors to be considered, you write, sir. Factors to be considered in determining reporting entities is equal to foreign entities is equal to functional currency. Whether both the entities have same functional currency or not. To determine that, there are certain factors. Okay now? Yeah. That is what I'm going to give you one by one now. First, no independency or no total independency or no autonomous or no autonomy.
So RE is equal to FO?
RE is reporting entity here, okay? Not retained earnings. RE here, when in the standard, whenever we use RE, it is a reporting entity. FO is for foreign operation. FLC is functional currency. Reporting entity, foreign operation, functional currency. You can say that both the entities have same functional currency by checking these indicators. Again, these are indicators, okay now? First one is no total independency of foreign operation. Or no total independency of foreign operation. Second one, high volume of transaction or high degree of transaction. High volume of transaction with reporting entity, RE. Third one, cash flow of foreign operation affects cash flow of reporting entity and gets remitted, and foreign operation cash flow is ready for remittance. Or one moment, if you don't want to write, so, or maybe I'll write it and then I'll maybe further simplify it. You can, instead of all this, if you want, you can also write cash flow of FO remitted, or cash flow of FO, can we use the word remitted? It's okay. Cash flow of FO, or you can just write given to reporting entity consistently. Instead of this, you can also write this. Cash flow of foreign operation given to reporting entity consistently. Fine. Fourth one. Cash flow of foreign operation, that is FO, is not sufficient to cover FO's debt obligation, or instead of this you can also write FO is dependent on reporting entity for funding requirements. If this is there, means we used to call this as integral foreign operation in CA Inter. And if it is integral operation, means then we could say reporting entity and foreign operation have the same functional currency.
The last point.
Last point. Okay.
Yeah.
Are we okay with this? I'll give you a simplified example.
Yeah.
Let's say there is a father. He owns a restaurant in India. Owns a hotel in India. Okay, now let's say a South Indian hotel he owns. This father, let's say he has two sons, S1, S2. One is in CA, one is MBA. Both of them completed their course or dropped out. We don't know. Yeah, something happened. Okay. Now they decided, since father is already like owning a hotel, let's continue father ka business. Let legacy we will continue, they said. Since father owns South Indian hotel, S1, that is son 1, he decided that let me also go to UK and set up another hotel, another South Indian hotel in UK. Fair enough. This is what son 1 decided. And son 1 asked father, give me 1 million pounds or 100,000 pounds you give me. I would like to set up a hotel in UK. Fine, this is what son 1 decided, wants to do. And father told, okay, no problem, happy, take it. Okay. Son 2 said, okay, nimdu kya hodre, namdu kya hogala. Okay, he told, I will go to US. Okay, you give me 1 lakh US dollars. Okay, this guy took 1 lakh pounds. This guy is saying, give me 1 lakh, 100,000 US dollars. I will open a hotel in US.
Okay.
Fine, and this is what they decided. Son, probably they don't like each other. Okay, hence they went to different extremes altogether. Fine, no? Yes. So now, son 1 is our lover, like our, he's CA student, no? Or he completed CA. He has that articles experience. Okay. So he respects the boss and all that stuff. Yeah. So what he does is, on a daily basis, he keeps on calling father. Father, okay, I am making idli today. Tell me what should be the batter ka quantity. How much water I should put to. How much spice I should put to. How should I make the chutney. Okay. Like this for all the decision, no? Son keeps on interacting with father.
Okay.
Whom to hire, where I should take rent, how much I should take rent. Correct? All this decision he jointly decides with father. He gives a call to father and then accordingly takes a call. Fine, no? Like this continuous transaction. And whatever money he gets from this hotel business, so he keeps on giving it to father. Because father gave him 1 lakh, no? On a weekly basis or let's say on a monthly basis, he keeps on sending the money back also to the father. Take father. And like this is what son 1 is doing. Fair enough?
Yeah.
Good with the example so far?
Yeah.
Son 2. Father gave him a call to son 2. He's like, son, how are you doing? You need any help? Son got furious, sir. I am an MBA completed student. I'm an MBA grad. I did it in hotel management only. I know how to run a hotel. Please don't disturb me. I know how to run it. I will run the hotel. You have given me the money, no doubt. I will give you the money. Okay, every year some money I will give it to you. Please don't interfere in the way I do my business. Because your generation was different, my generation is different. My thinking is different, your thinking is different. Allow me to do my process. Okay, you have given me the money, I will give you your money back. At periodic intervals. Every year, once in a while, I'll send you the money. Are we okay, sir? Example. Now you tell me, father will be concerned about which son now. I'm not asking emotionally here. Okay. I'm taking financially. Father is concerned about which son?
S1.
S1. Because S1 ka operations directly affect father ka operation.
Right.
Correct? Because S1 is like continuously interacting with the father, is taking all the decisions by having conversation with father only, and money also is remitting.
Yeah.
But S2, once in a while he's sending the money. Correct or no? So this we call it as integral foreign operation. This we call it as non-integral foreign operation. This is what you learnt it in your IPCC. I'm just giving you a recap of that. Okay. In IND AS 21, we don't have integral or non-integral foreign operation. What we say is, if this is the case, means though the son may be in UK, but actually son ka business or son ka hotel business is just like an extension of father ka hotel. Yes or no? It's like father has another branch in UK. Correct? So if this is the case, means we say father and son ka functional currency is one and the same. Did you understand? There are some factors. Just I'm telling you with examples here. I mean, just as a random this thing. Okay? Are you able to understand it? Because son, one moment, don't jump guns. First, expense will always be there. If you are a different country, means you will incur the expense in that country ka expense only. But here, like if the foreign entity ka operation is conducted like an extension of reporting entity, in that case, if that is the case, means we say reporting entity. Reporting entity is reporting entity is this F1 father.
Yeah.
The reporting entity and son is your foreign operation. They both will have a same functional currency. Yeah. They might be presenting their financial statements in pounds. It doesn't matter. But their thinking will always be in INR. Because son will always think how to give the money back. No. Correct? And how much to price for that Italy. Correct? All that decision is taken by father only, no, in a way.
Yeah.
Correct? That means what? Was father thinking in what now? Dollar value or a pound value or INR value? If father thinks in rupees, even son 1 will be thinking in rupee only, no? Because he has to remit to the father. Correct? So the son 1 cooperation is like an extension of father's cooperation. Now, if that is the case, means both the entities will have a same functional currency. That is what we wrote as condition. Are we okay? Now maybe can we look at the conditions and come back? First condition we wrote is what? No total independence of foreign operation. Here the son 1 is doing the operation independently, sir, or he is continuously interacting with father? So first indicator, if it has to be, if for foreign operation reporting of entity ka foreign functional currency has to be different, means that foreign entity should function independently. They should take their own decisions. Here, is there autonomy, sir, or is there any dependency? So if dependency is there, means that is an indicator strongly that both of them functional currency is same. That is the first indicator. Are we okay? Second condition is what did we write? High volume of transaction with reporting entity. Isn't father and son having a high volume of transaction here? Yeah. Correct? Cash remittance. So if the transaction between reporting entity and the foreign operation, if it high in volume, means that is an indicator again that both of them will have a same functional currency. Indicator, I'm saying not a condition. Again, indicator. Case to cause, you have to analyze. Okay, now that is an indicator proving that both of them will have a same functional currency. Manageable. Third condition is what? Or third indicator is what? Cash flow of foreign operation directly affects cash flow of reporting entity. You tell me now, if son makes any cash, wouldn't affect the father? Because continuous remittance is there, no? Correct? So son 1 is foreign operation. Foreign operation ka cash flow is directly affecting father. So if that is the case, means we say that like what? Reporting entity and foreign operation ka functional currency is one and the same. That the third condition. Fourth condition, what we learned? Cash flow foreign operation is not sufficient to pay off for debt obligation. If son 1 does not have enough money, here in this case, let's say he was not able to pay some salary to the employees, what will he do immediately? Call father, take the money. That means he has a backup of father here, correct? That means in a way he knows that no matter what, I can always depend on my other entity for my funding requirements. If there is dependency like that, that is an indicator that what? These are not two entities. Just for the namesake, you are calling it as two entities. Actually, it is what? Yarudu Deha, now Vandu Manusu, something they say, no, like that it is. Fair enough? There might be two entities operating in different country, but both the entities ka functional currency is same. Why we need to subrogate? Because exchange rate defined for these two are different. If it is this, means you will use one set of exchange rate. If it is that, means you will use a different set of exchange rate. Hence, it is very important to identify whether that foreign operation and reporting entity, their functional currency is same or different. Got it? For transaction or translation purpose, different exchange rates are suggested. Hence, easy so far or okay? These are 4 indicators. So what will be Sun 2 now? Sun 2, is he dependent now or is doing autonomously on himself? Autonomously. That means it's an indicator that their functional currency are not same. Correct? Second indicator was what? High degree of transaction. Are they transacting continuously or once in a while he is giving dividend to the father? Once in a while he is giving money back to the father. Yes or no? There is no high volume of transaction with the reporting entity. Correct? Again, an indicator that these two entities' functional currency are not same. Yes? Like that. Cash flow dependency is not there. Correct? Cash flow remittance is also not there continuously. Correct? No, sir. Why will you remit the funds to a reporting entity, you tell me? Because reporting entity is saying how much ever you require you keep, rest you give it to me. I am framed, correct? I formed, give me. Yes. So that means what? These two guys for the namesake may be different entities, but actually their functional currency will be same. Got it? But here is son one giving entire money to, if he generates the money from hotel business, will he give off the entire money to father? No. Correct? If he generates, suppose $1 million, 10 lakh pounds he generated from his business, will he give off entire 10 lakh to father? No. He will say, you gave me 1 lakh, take your 1 lakh back plus something else. Possible? That is the case, means what? You could say indicate that these two are functional currency are different. It's a case to case basis. I'm just giving you a broad framework. Okay. So based on these indicators, you conclude whether reporting entity and foreign operation ka functional currency is same or different. Got it? 4 pointers. Can you give me a quick recap? Because next question we have to apply first 4 prime indicators also to find out functional currency, and next 4 indicators to find out whether reporting entity and foreign operation are having same functional currency. First, tell me that, sir. How will you identify functional currency? 2 primary indicators. One is the currency in which sales are denoted, and the country's competitive forces and regulation which affects the selling price determination. 2, the currency in which costs are denoted. 3rd, the currency in which fundings are raised. The currency in which investments are made. Correct? First 2 are primary, next 2 are secondary. Doesn't mean all of them should be satisfied. No, these are just indicators, not conditions. You look in and analyze case to case basis. That is that. Based on that, you take a call. What call can you take? Which currency is a functional currency? Like that, you will identify. Yes. Next, if you have 2 entities, one is a reporting entity, another one is a foreign operation. Now your headache is what? Whether both of them have a same functional currency now, or they have different functional currency now. To find out that, again 4 indicators were there. What are those 4 indicators? 1, that foreign operation is not carried like independent. They are dependent on the reporting entity. So like what? The foreign entity is as an extension of the reporting entity. It's like that. Okay, so that is the first condition. What are the condition for, by the way? These are condition. What are we looking at? Whether foreign operation and reporting entity have the same functional currency. To test that, we have 4 here. Correct? No. One is no dependency or no independency basically. Alright. Second one is what? What did we write? High volume of transaction with the reporting entity. Foreign operation and reporting entity are transacting quite often. How often? They're not defined. Or what is high volume? Not defined. Case to case basis again. Fine. Third one. What is the third one? Cash flow foreign operation affects directly cash flow of reporting entity. Why? Because continuous remittance will be made. So, got it? Fourth one. Foreign operation activities are not sufficient, correct, to pay off their debt obligation. If they have any loan, they have to pay their expense, means their money is not sufficient. So they are dependent on whom? The reporting entity for funding requirements. Got it? So if these are there, means you could say that like what? Foreign operation and reporting entity functional currency are same. If they fail, not necessarily all of them should fail. If most of the indicators are not satisfied, means then you will conclude reporting entity and foreign operations are having a different functional currency. Can we apply this in the next case study? This is what they've given here. What we just wrote now, no? That's what they've given here. And foreign operation means, does it mean it should be a branch, sir? No. Foreign operation means it could be a branch, it could be associate, it could be subsidiary, or it could be a joint venture. And does it mean it should be conducted in some other country? Not necessary. It could be conducted in some other country, or it could be conducted in currency other than that of reporting entity. We saw the definition before only, correct? No? Yes? All right. So indicators, we just saw 4 indicators. We wrote the short form also. Yes. Can I move on to the next question?
No problem. Yes, sir.
No problem. Okay. Question number 2. Small India Private Limited, a subsidiary of Big Inc. So subsidiary is in India. Big Inc means probably it is in US.
Yeah.
Takes orders from Indian customers for Big Inc's merchandise. So first of all, is the small India producing its own product or it is selling holding company ka products?
Selling like agent for holding.
They are an agent for holding company, correct? No, aptly said.
Yeah.
And then bills and collects the sale from the merchandise in rupees. Since the customers are in India, so they will pay in rupees, correct? All right. But is it small car product or it is big car product?
Big
Now you tell me naturally what will happen.
So
Some portion they will keep it probably as commission and remit the balance to big. There itself, like we are trying to conclude, we can conclude one thing. What is that? There is a dependency. Small cannot operate without big. Yes or no?
Yeah.
If small can operate without big means what? Both are different entities, correct? But here small is totally dependent on big. Big shuts down means even small will shut down.
Yeah.
Okay, so that means what? Looks like small and big will have only one and the same as functional currency. Yes, no?
Yeah.
If they give big ka functional currency, then automatically that itself will be small ka functional currency. Doesn't matter that small company is in India. I told you, just because you're in India does not mean INR becomes your functional currency. It could be different. Yes. Let's see. Small Limited also has a local warehouse to facilitate the timely delivery and ensure that it remits to its parents all the cash flow it generates. So entire money, they're not even keeping anything, Papa. Entire money they're remitting to the parent. Yes, no?
Yeah.
Remits to the parent all the cash flow it generates as operations of small are primarily financed by Big Incorporated. Funding also we are dependent, correct?
Yeah.
And Big Limited is based out of US and it has functional currency as USD. What is Small Limited ka functional currency? Small Limited ka functional currency, obviously here there is a big dependency on there's a dependency on Big Limited here.
Yeah.
Now, whatever is Big Limited ka functional currency, that itself will become small ka functional currency also. Yes, no?
Yes.
Therefore, what is the conclusion?
USD is the functional currency of small.
So functional currency should be USD. Yes, no?
Yeah.
But Small Limited has to present their financial statement in
Yeah.
INR. That is that. But they're concerned about, their main concern will be about which currency now. Since they have to give everything to US company. US company will always say, make sure that dollar, it should not reduce below this dollar. Like that only they'll be concerned about. I mean the main currency in which they're concerned about is a dollar in this case. Done now. How will you answer this question? We'll write the 4 indicators that we just now wrote here.
Yeah.
Where? Here. All this indicators you'll write and conclude what?
Conclude that the functional currency
Here a
of
small
subsidiary
in the present. You want me to give a sample answer or okay?
sample probably.
Okay. Okay. First point I will write 4 indicators. Is it okay? Again, I will not write the 4 indicators.
Yeah.
So write 4 indicators. Correct? No. Of what?
Yeah.
Of what? Reporting entity is equal to foreign operation is equal to functional currency. That's what we wrote the indicators. No. Right. That's 4 indicators pertaining to that condition. Point number 2 we will write. In the present case, comma, small India Private Limited. Where is it? Small, they've not given. Where is it? Small Limited only. Okay, Small Limited is a pass-through company, we say. Meaning, name say company. Meaning goods has to pass now from big to customer. Okay, so for that we have just we have opened one company we have formed. Hence, it is a pass-through company or pass-through entity. And is dependent on Big Inc. for its funding requirements. For its funding requirements and remits all its cash to Big to Big Inc. Small Inc. Corporation or Small Limited Corporation. Small Limited Operation is not carried out autonomously. Can I write?
Yeah.
is not carried out autonomously or independently. Independently will write. Is not carried out independently. Therefore, one more point I can write. Big Inca functional currency is what? Big Inc functional currency is US dollars.
Yeah.
Therefore, small limited functional currency is also US dollars in this particular case. Hope manageable. Now I think slowly you're getting the hang of it. How to identify functional currency and all.
Yeah.
Okay. Is it necessary in all the cases? This will only be the answer. It might change also. What if small limited starts its own operation by selling locally? If they start locally buying the goods, then it might vary. That's what I said there. It is a case-to-case study. Fair enough. You can't have one conclusion. Hence, that's the reason nowhere you see the word they've used the word condition. They always use the word indicate. So it involves a significant judgment call there. Fine now. Okay. Anything you have to write?
Yes, sir.
Okay. Last point. Okay.
So can we finally say big Inc and FLC will be equal to small?
I'm not able to. Voice is gibberish.
Can we conclude that big incorporations of FLC will be equal to small limited FLC?
Yeah, that's what we have written. Big FLC is US dollar. Therefore, this guy FLC is also US dollars. That's what we are writing. Same. One?
Yeah.
Okay, next question. Question number 3. A is a Oman-based company having foreign operation B in India. Main company is in the Oman and they have a foreign operation in India. What sort of foreign operation? We don't know. They have not given. Could be branch, could be JV, could be associate, could be subsidiary, could be anything. Yes. The foreign operation was primarily set up to execute a construction project in India. So this Oman company has formed this B company in India so that this B in the company in India can do one construction project. Okay. The functional currency of A is OMR. Box that. Functional currency of that is OMR. 78% of entity B's of finance has been raised in US dollar by the way of contribution from A. Underline the word US dollar, sir. Funds have been raised in what, sir? So there's an indicator, remember? Secondary indicator. One of the secondary indicators is the currency in which the finance has been raised. Here the finance of B is raised in US dollar. Keep that in mind. B Limited bank accounts are maintained in US dollar as well as INR. This B maintains his bank both in dollar and INR, it seems. They have a bank account only. Okay. Cash flows generated by B are transferred to A. Yes, then it looks like now what? Dependency, correct?
Yeah.
But let's, no, don't conclude. Hang on. Cash flows generated by B are transferred to A on a monthly basis. One moment, hang on. In respect of repayment of finance. Underline that. Entire cash flow is not generated. Entire cash flow is not remitted. Suppose this Oman based company gave 1 lakh loan, correct? And if this B, that is local company in India, if they generate 10 lakh cash, will they give entire 10 lakh to that Oman based company? No, only 1 lakh. That means what? We are not giving the total funds here. We are only like what? You gave me the money, take your money back. Don't ask even 1 rupee more, correct? So now it looks like may not be dependent. Yes or no? Indicator that way. Yeah, just because the remittance is done, don't conclude. They'll frame like this also. Yeah, possible. Alright. So now it indicates, I think we are having a strong indicators now that both are not dependent. They're functioning independently in a way. Yes. Okay. Revenues are B is in dollars. Funding currency was dollar. Revenue is in dollars. Correct? Two strong indicators. And investment. Investment means, what? Bank account. The bank account is maintained in dollar as well as INR. Yes. So 3 things, 3 tick marks for dollars so far. Correct? So it is indicating that this B company, though it is in India, it might have a functional currency as dollars. Possible? Let's see. Revenue of B are in dollars. Its competitors are globally based. Tendering for construction also happens in USD. Now pakka, sir. You win the projects. For that, you call out a tender, and the tender also is called out in dollars. That means what? Even your cost also is incurred in dollars. So it's almost like all the 4 ticks for dollars.
Yeah.
Yes. So 70% we incur 70% of cost in INR, balance 30% in US dollars. So tendering cost maybe like is not that significant. Fair enough. But 30% cost is that significant only, That means there are many. All the indicators are not getting satisfied definitely here, but most of the indicators are pointing towards what? You're concerned about dollars more than INR. Yes or no? That is how you put one above the other. You ask the question, how do you ascertain? Correct? Like this, you'll have to take a call. If proportion changes, sir, functional currency can also change. Hence, I said don't overthink. Possible. Every year, like that, you can't take a call. There are some conditions. Let's read further. Why not? But it could change. It could change. I'm not saying a functional currency once decided has to be fixed. It can change. But we can only answer with existing facts. Got it? Don't overthink. Because when you overthink, you'll be like, you'll say, hypothetically, what if this happens, that happens? If that happens, means you'll have to change from this to that. Hence, I can't give you an answer in hypothetical scenarios. Considering existing fact, we can write existing answer. Fact to change, answer also might change. Okay, now? Alright. B is located in India and can presume that function. Can it presume that its functional currency is INR? Absolutely not. Just because you are in India, does it mean your functional currency is automatically INR? Obviously no. Yes. That means how will you answer this question? You tell me. Here both are there. Both are. First, you will write primary indicators. Primary indicators, secondary indicators, 4 things you will write. Correct? And you also have to write that what? Reporting entities conditions. 4 indicators. That means totally 8 things you have to write here. So much. Take a call based on marks. Okay. If they give for 2 marks and all, don't waste your time so much. Okay. Write it in short words and move on. I know. And then accordingly conclude what? 2 conclusions you have to give. What is first conclusion? First, this Oman based company. A Limited and B Limited. Yes. A Limited, or rather, can I write it this way? A's functional currency is not equal to B's functional currency. Because looks like B is running independently. Okay, that is one conclusion. And then you will say, calling out primary indicator and secondary indicator, you will conclude that B Limited functional currency is US dollars. Correct? Now, looking at most of the ticks are getting is in favor of US dollars. You will conclude that. So, write indicators and conclude this. That's all. Can you manage this? Fine. Anyway, answer is given. Yeah.
So 30% of USD in cost doesn't really matter.
The 30% US, that's what, funding is in US dollars, one big tick. Revenue is in dollars, one big tick. Cost, the investment ka 50-50 it is. Correct? 50% in USD, 50% in INR. Correct? So cost is in 30%. So that means you could say that one USD is having a little trump over the INR. That way you are concluding that it is an INR. That's it. Fine. Now, if proportion changes, maybe from USD you might shift functional currency to INR also. Possible. For the time being, it is not so.
They have independence also.
Which one? They have independent. I'm not concluding. Sir, A's functional currency is OMR. Okay, we're not talking about A and B at all here. We're only talking from this perspective. Can B's functional currency change from US dollars to INR? Possible. If all the tendering requirements, if they if they repay the money to A and give fresh equity shares in India and raise the money through INR, correct? And if they take up local projects in India again by bidding for the tenders in INR, then possible that many facts have changed. From US dollars, you may have to shift to INR also. Possible. Yes? But for the time being, no. We'll conclude this only. Done now? Can I move on to the next one, or anything else you want me to add or you want to add? No, sir. Then move on to fourth question. Question number 4. Or fourth homework kotre ಮಾಡ್ತೀರಾ? If it is, yeah, okay, actually, let's do it. It's fine. Anyway, 2 minutes will take. Yeah, we'll finish. S Limited is a company based out of India. Are you writing anything for the previous question, sir? Or okay, finish. No problem.
So here, A's functional currency is actually OMR, right?
A's functional currency is OMR only. Yes. What did I write? I wrote A's functional currency is not the same as B's functional currency. You can write that. Yes, it is not, because A's functional currency is OMR, B's functional currency is US dollars. Hence, they are not same. Actually, take question number 4 as homework. Anyway, every other question I have to do. It's practical only. Okay, I can't give that as homework. Take this as homework. It's fine. Manageable only. Fine. Now, you remember the second factor? What is the second factor? Or rather, first primary indicator was what? Sales. Sales had a second condition. What is that? It was a junty condition. 2. What is that? Once the sale, the functional currency means the currency in which sales are denoted, and the competitive action and regulation which affects the selling price. Yes, no. Here, Indian competitive action affects the selling price. Fine, they've given the conclusion. Okay, keep that in mind and conclude. You'll be able to manage this. Fine, now read it. It's okay. Sorry?
Question number 4, right?
Question number 4, you take it as homework. It's fine. Manageable?
Yeah.
Alright. Now, we will start with the main funda. Accounting. So far we saw what is functional currency, presentation, no, and all that stuff. No. Now the accounting. Before accounting, I'll give you a small chart for accounting. You write that chart. Then we can go for the next question or maybe the next concepts. Right?
So now the initial doubt I had, that cost plus entity of US subsidiary in India.
You'll have to take a call based on judgment. Okay. So
only then 100% revenue is coming from this.
Where did the funds come from?
US.
Where did the funds come from?
Funds also initially came from US.
Initially came from US. Are you remitting entire funds back to the US?
No, I mean funds they are remitting to us. No, it's a
they gave you the capital, but you will generate the operation and you will generate that income. Correct? No, that income. What are you doing? Are you remitting totally back to the US company, or you're gonna be reinvesting in India? Who takes a call on that?
I mean,
both of them take a call, or is there sufficient independence given to the local entity? It has. You have to consider many factors. You have to take many factors there and conclude. It's not easy. So if India cooperation can function independently, it's like US is telling, okay, I'll give you the funds, generate this product. I will give you this product, a process that this is what you should do. But you hire your local engineers, redevelop it or improvise it. Okay, I'll give you a liberty or free hand there. Okay, you are free to choose at what price you will sell to the customer, to which customer. Okay, I have restriction that don't sell it in US, sell it in any other country you want. Like this, if free hand is given, then it looks like A is functioning independently. Correct?
But here
A is
selling 100% to holding only, no?
Sorry, sir?
They're selling 100% to the holding.
Oh, you mean to say given back, but give the product, and then obviously it is like big and small then.
So it's revenue 100% is generated from
then total dependence then. Then no, you shouldn't even ask that question. Okay, we develop a product and we do cost plus billing to holding company is what you're saying. Okay, that scenario, transfer pricing wala arrangements. Okay, so in that case, it'll be total dependency. Correct? No, because we can't sell it to any other customer. Okay, and margin also is like predefined that way. Yes, so it will be like, though you are incurring your expenses slightly in your Indian cost, you'll incur rentals and engineer cost and all, but you're thinking mostly will be in the dollar there. It should be dollars. Fair enough. But again, just based on your facts I'm giving you, okay, again you'll have to look at more factors. Don't argue with your auditor saying, he told this, how can that be? You'll have to conclude. It can vary based on case to case. But looking at your question, to me, it looks like a US dollar, total dependency wala scenario. It looks like though you have an entity in India, it is not a separate entity. It is like US company has set up a branch or it has set up another arm in India. Looks to me like that based on the first circumstance you have given me. Fine now? Alright? So this is my thoughts on that. Manageable? Okay, awesome. Can I move on to the chart one now?
Yeah.
Okay. Conversion, you write, sir. Conversion rates to be used. Conversion rates. First, you have to determine type of item. Item means whether it is a monetary item or a non-monetary item. And conversion rates, one moment. Conversion rates for foreign currency transaction, you write, sir. For foreign currency transaction. Foreign currency, can I write FC? For foreign currency, or maybe we'll write full thing. Why? For foreign currency transaction. We're not talking about branch and all here, okay? I'm talking about plain. One company is there in India, one or two, or some transaction they're having it with other currency. Functional currency is INR only. Some transaction they're having it with other than INR, like a dollar, or pounds, or anything. In that case, how to convert or which exchange is to be used for conversion. That's what first I'm discussing. Next, I'll give you a separate chart for what if you have a foreign operation, how to convert. Then I'll give you another chart for what if that foreign operation is a subsidiary, what you should do the conversion. So 3 charts will come. This is only for transaction, okay? So don't ask me a question relating to subsidiary and all now. So conversion rates for foreign currency transactions. So if you have any foreign currency transaction, what conversion rates you need to utilize? First, you have to identify what type of foreign currency transaction is this, or you can just write that only. Types of foreign currency transaction. Types of foreign currency transaction. Whether that foreign currency transaction relates to monetary item, that we call it as MI, or it relates to non-monetary item, that is NMI. Whether it's a monetary item or a non-monetary item. Fine. If it's a monetary item means we know what is the meaning. Monetary item are those items whose value is fixed. Yes. Value is fixed. Actual definition is they are expressible in fixed denomination of currency. Expressible in fixed denomination of currency. Denomination of currency. In simple term, you can just call it whose value is fixed. Examples could be? Examples could be debtors, cash first only. Cash is a monetary item. Your debtors, or you can show off and write financial asset debtors. So cash or debtors or loan taken, loan given / taken, etc. etc. All these are monetary items. Okay. Then we'll come to non-monetary item. Non-monetary means what? Other than monetary item. Meaning value is not fixed now. Value is not fixed. Value is not fixed. There examples you can write it as PPE, IP as in investment property, IA as in intangible assets, inventory, investment in equity shares, equity itself means equity share capital. That is a non-monetary item. Yes. But however, if equity shares are used as currency, then can you classify that as equity as per IND AS 109, or you should classify that as a financial liability? Value is fixed, correct? No. Yes, we remember. Then it becomes a monetary item there. If equity is used as currency, then it becomes a monetary item. Otherwise, no. Yes, that is as per IND AS 109, which I'm testing. Hope it's okay for you? Yeah. Alright. As such, equity share capital is a non-monetary item. Then you can write prepaid expense. Prepaid expense. One moment, I'll explain why is that. Advance to supplier / from customer, or rather advance from customer. Advance to supplier, comma, advance from customer. Advance from customer. In bracket you can write unless advance is non-refundable. Unless advance is refundable. Understood? Prepaid expense, why is it not a monetary item, sir? So prepaid expense means your insurance and prepaid salary and all. Are you getting any money out of it, or are you getting any service? Value is fixed means you should be able to express it in a particular currency, meaning it should be related to cash len-den. Correct? No, prepaid expense, we already paid it. Correct? Fair enough. So in return, what are you going to get? Are you get cash back, or are you going to get service back? You're going to get service back. Yes or no? Correct? Hence, we say it is a non-monetary item.
So, but I paid fixed cash, no?
You paid fixed cash, but we are talking about subsequent measurement here. Subsequently, what are you going to get? Sir, there also you said, is prepaid expense a financial asset? Did you treat prepaid expense as a financial asset? Why? You treated it is not a financial asset. Why? Because financial asset means it's a contractual right to receive cash or equity shares. But in prepaid expense, you have a contractual right to receive service. Correct? No. So that means, can I say like all financial assets are monetary items, sir? Yes, you could say that. Correct? But if you have equity shares, it may be difficult for you to express that in fixed denominations of currency because its value will keep varying. Hence, equity shares of another company, investment in equity shares, we treat it as non-monetary item. Got it? Prepaid expense is considered as a non-monetary item because in return you're not getting cash. You paid the cash already, all right, fine, correct? But are you going to get that cash back, or are you going to get the service back? And can you put a value to that service, sir? Definite value. Cash, if you have 100 rupees, means it's 100 rupees, correct? No. Debtors, if you have to receive 1 lakh, means it is 1 lakh only, correct? Prepaid expense is difficult to put a peg a value because you're getting a return by service, correct? No. Hence, we classify that as a non-monetary item. And advance, why am I classifying? Again, advance, if you paid the advance to supplier, in return, what are you going to get? Goods, correct? But if transaction gets cancelled, means you have to refund the advance. See, if advance is refundable, means it becomes what? Monetary item. If it is non-refundable, means non-monetary. Like that. Understood? So, subjective answer there. Yes, no? Are we fine? Actually, we should write what here? Unless advance is refundable. Refundable means it becomes this one, no? Should we write non-refundable here, no? That's what we should write. Any confusion? Unless advance is non-refundable, correct? Okay, so this one. So why am I writing monetary and non-monetary item? Because the exchange rate that you use, no, depends on whether it's this component is a monetary item or non-monetary item. If it is monetary item, one exchange rate. If it is non-monetary item, another exchange rate. Yes, no? So now coming back to the conversion. So write the part 2 as point number 2 as exchange rate. Exchange rate. Write ER. Exchange rate ER. How will I present this? Hang on. Okay. Exchange rate. Then we'll write transaction date. Then we will write settlement date. You have learnt this already in IND AS 11, correct? Initially, all foreign currency transactions are recorded using transaction date ka spot rate. That is what I'm calling here. Whatever transaction it is, whether it's monetary or non-monetary, all transactions are initially recorded on transaction date at what? Using what? Exchange rate will be what? ER will be transaction date ka spot rate. Transaction dates spot rate. Got it? This is one. And when you settle that, you purchased goods today. So you'll use today's exchange rate and record the purchase. Purchase account debit to creditors. You'll pass the entry, correct? Suppose you're paying tomorrow. That means you'll pass the journal entry creditors account debit to bank. To bank, you'll write what? Tomorrow's exchange rate. Yes or no? So transaction and settlement will happen at the spot rate only. Exchange rate is relevant more towards the foreign currency balances. You bought today. Let's say you bought it on 29th March. You bought goods on 29th March from the supplier on a credit basis. But credit period is 1 month. That means you will pay the amount 29th March or next maybe 29th April. Between this 29th March and 29th April, there is one important date known as 31st March on which you have to prepare balance sheet. That means that creditor now will be shown, you have to be shown in the balance sheet. At what exchange rate should I use, and that creditor should come in in balance sheet at what rate or at what value is what we have to see. That is the crux. Okay. Transaction settlement is not a problem because transaction happens means use exchange rate on the transaction date and record it. Settlement happen means what will be the exchange rate then in that case similarly? ER will be what? Settlement date spot rate can I say? Spot means on that spot. Whatever was the rate used, that rate. Alright, so that is for transaction and settlement date accounting. That is not a problem, correct? Next, you have to see what? Point number 3. Point number 3 will be for, so how much long it will go? Not very sure, sir. You can probably cut it and make separate charts for yourself if you have a space constraint. It might be a little lengthy because even I'm thinking and making. Fine now? Or else actually I could have seen the chart that I've already made. Okay, no problem. I don't have that handy. So I'll go on doing it. Okay. You can do it in separate pages if you want. So all this is there in the chart. Very much yes. The final chart we have. All this already incorporated also. For the sake of problems now we require. No. And we should practice once. Correct. So for that sake we are writing again. Alright. Next you write. Converting conversion of foreign currency balance. Conversion of foreign currency balance. Under that you write. Now we have to check whether that foreign currency transaction is a monetary item. Can I write MI now? Yes or? So if it is MI means IND AS 21 says, and even AS 11 also told the same thing, you have to use closing rate. When you use a closing rate, initially you would have recorded that at transaction date ka spot rate. This transaction date spot rate, and will closing rate be same, sir? It could fluctuate. It will mostly fluctuate. That means there will be some gain or loss. So that gain or loss should go to SPL or PRL. This is the funda. Got it? So if it's a monetary rate, you use closing rate, and gain loss due to exchange fluctuation will go to SPL. No worry, we'll do a problem also. You have done enough number of problems in AS 11. We'll do a few of them here also. Then next one. Next one is what? Non-monetary item. If there is a non-monetary item, one moment, hang on. Non-monetary item means, is PPE a non-monetary item, sir? Is PPE a non-monetary item? Yes, because value fluctuates. Should PPE valued? Is there any one metrics to value PPE, or there are more than one metric? Either you can use a cost model. I'm not talking about depreciation. Either you can go for cost model valuation, or you can value under revaluation model. Revaluation means fair value. Correct? So first you have to check if non-monetary item are valued at cost. If this PPE is valued at cost is what you have to check. Okay. If it is valued at cost means use transaction date ka spot rate. Use transaction date spot rate. Meaning whatever value initially you would have converted this already using transaction date spot rate. Use that only, and no gain loss will come. No gain loss. No G/L. Okay, can I write this way? This is only for not necessary. Even inventory is valued at cost or NRV, whichever is lower. So that could also be. I mean, even investments generally we value it at what? ACM method, FETPL or FEOCI. Possible. Yeah, you'll have to just check which is getting valued at what. But majority of them will get valued at cost only, no? Or if you're valuing it at any other basis, or let's say fair value basis. Is it okay? If I write fair value basis, let's say that non-monetary item is valued at fair value basis. Then what will happen, sir? The day you buy and the day you're doing fair value, should it be same? Or today you can buy and tomorrow you can adopt fair value? Possible, no? Fair value is generally adopted, no? Correct? At a different date. Yes, that means what you have to do now? You will write use exchange rate. Use exchange rate on what? On the date. On fair value date, can I say? You use the exchange rate that is applicable on the fair value date, and this exchange rate and transaction date, exchange rate, will it be same or there will be a difference? There will be a difference. That means there will be some gain or loss. And gain or loss as per respective IND AS. Perfect. Then gain loss as per respective IND AS, meaning what? Sir, for IND AS 16 PP, it says if you're doing revaluation model, that revaluation surplus, will you book it in P&L or will go to OCI? That means that exchange gain or loss also will go to OCI. Suppose for investment you're following FVTPL method. That means fair value. You have to find, on the day you have to find the fair value. On that, there will be an exchange rate. Take that. Correct? That means there will be fair value gain or loss. That gain or loss will now go to PRL. Suppose you are following FVT OCI. Then the gain loss will go to OCI. So that depends on the respective IND AS. Got it? Like hence we have written this way. So that means it can go to either OCI or it will go to PRL. Manageable? Like that. So this one non-monetary items. I'll write one more. Okay, let's do a thing. Or can I make it as a separate chart? Okay, let's do a thing. I'll make this as a separate extension. Last part, sure.
No gain or loss.
No gain or loss, yes. Because you are using transaction date spot rate, no? Initially only you would have converted this, correct? No. When the transaction happens, any transaction happens, you would have used transaction date spot rate. Take the same value and show it in balance sheet, sir. No gain loss, no remeasurement basically. Fine, now. If you are valuing that NMI at cost. If you're valuing at fair value means you have to use the day on which you found out the fair value, and accordingly gain loss also will come. And gain loss has a different treatment also. Yes, sir. Next you write fourth point. Third point was conversion of foreign currency balance.
Yeah.
Fourth one you can write net investment in foreign operation. Net investment in foreign operation. This, if you want, again, this chart will go might be a little big. If you want, you can make a separate chart for this altogether. If you have a space problem in your notebook. If you have any net investment in foreign operation, then first thing, we have to check whether this is an investment in equity shares or whether this is a receivable payable wala transaction. Whether it is investment in equity shares or whether it's a receivable payable wala transaction. One moment. Investment in
equity share and anything other than
only investment in equity shares. Other things will probably get covered. That we don't call it as investment in foreign operation. Or maybe what you can write is investment in foreign operation means interested in net assets. Interested in net assets of foreign operation. Which investments give you a net asset entitlement, sir? Only equity shares. So only that we are doing there. Other investments we'll see what to do. Okay. If you purchase any debentures, right? Sir, you should not be asking this question in a way, because if it is a debenture means for one company it will be an asset, for another same subsidiary it will be a liability. When you consolidate, net off. Fine, na? There's one extra adjustment that will come. We'll see that later. For the time being, I'll not do that. Yeah. So leave that.
How will you get net investment?
One moment. I'll tell you what that is. I've not yet completed the chart. You have to check whether this is receivable or payable. Okay. I'll tell you. We have a couple of problems also based on this. Don't worry. Hence, I want to do up the chart and then take up the problem. So, investment in equity shares means in separate financial statements, how will you value the investment, sir? You remember we had IND AS 27 separate financial statement. That gave you a guidance. Investment in equity shares subsidiary can be valued either at cost basis or you can go for fair value basis. Either was allowed. Yes. So that's what you have to check. How are you valuing this investment? You have to check valuation basis. In SFS. SFS means standalone or separate financial statement. So why CFS? So CFS means investment will not even come. Correct? No, that's what is consolidation. Correct? No. This investment you're going to compare with net assets. Balancing figure only is goodwill and Bapuji. No. Bargain purchase gain. Yes. That's what we do. So this will not come in SFS, CFS there. This will only come in SFS, separate financial statement. Yes. So in SFS, it could be, this investment could be valued at what? Valued at cost. No, possible. In SFS, if it is valued at cost means, one moment. Is this chart looking off fine? Yeah. If it is valued at cost means, then transaction date spot rate. Use a transaction, or you can just write transaction date spot rate. Transaction date spot rate and no gain / loss if it is valued at cost. Same like NMI, because it is NMI. In parent financial statement, investment in equity shares is an NMI. No. How will you value NMI? If it is valued at cost means you use transaction date spot rate and no gain or loss. Correct? But is it the only metrics, or it could also, you can value it at fair value basis also? You can value at fair value also? Valued at fair value. Valued at fair value basis means, then what you have to do now, this also we covered. Can you tell me? This is just for only for subsidiary. I'm just giving you one extra point. Understand? Valued at fair value basis means what, sir? You bought it initially 1 year, on 1st May you bought it. Okay. On 31st March, you want to value that investment on a fair value basis. That means what? There'll be some gain or loss. Because initially you would have used 1st May ka transaction date. Now we have to use 31st March ka end of the year ka transaction date or exchange rate. There'll be some gain or loss. What will you do for that gain loss? Sir, that depends on whether you're following FVOCI method or FVTPL method. If you're following FVTPL method, gain loss to PRL. If you are following FVOCI method, It is irrevocable option. That means that OCI will never go to PRL. On disposal, it will remain in OCI, but on disposal from OCI directly it will go to retained earnings, because these are known as non-reclassifiable gains. All this we have done. Okay, once upon a time I can understand, long back, but I think little bit you're not freaking out, I guess. Somehow it looks like we have done at least. Yeah. Okay, fine. If that is there, that is okay. Good enough. Okay, valued at fair value basis means you use what, sir? Exchange rate on what? Exchange rate on fair value date, can I say? Whichever date you are finding the fair value, use the exchange rate on that particular date. So obviously there will be gain loss. And gain loss can either go to OCI or it could go to PRL, because that depends on the way you are valuing the investment. Yes, no? You want me to write that? Or is it okay if I stop it at OCI PRL? If you want, I can write if investment is at OCI means it will go to OCI. If investment is valued at PRL means that gain loss will go to PRL, like that. Right? Means right? Or maybe we'll write up here. Gain loss. Okay. And gain loss, instead of gain loss you can say. And valued at OCI method andre, or I can write investment valued at FVT OCI means then gain loss to OCI. Correct? Else I'll write PRL. Yes, is it okay? Else PRL. Then now one portion is okay. All this is in separate financial statement only. Okay.
Yeah.
Okay. Next, if it is receivable payable transaction, what do you mean by receivable payable transaction is, let's say the parent has given a loan to subsidiary. For parent it is a receivable financial asset. Correct? For subsidiary it is a payable. Correct? So this is receivable payable means they will get net off. No? Why are you bring it in here? Yes. The problem here is receivable and payable will get net off. But we are not talking about normal companies here. We are talking about parent is in India, subsidiary is in US. That means you will give the loan not in INR. You may give the loan in dollar. I mean there will be some exchange fluctuation. Principal amount of the loan will get knocked off. For one guy it's an asset, for one guy it's a liability. That will get knocked off, correct? But exchange loss will remain. What you should do for that exchange loss is what I'm trying to give you. Understood? Fair enough. When you consolidate, if suppose I gave you, I'm a parent, you are subsidiary. I gave you 100 rupees loan. I will show 100 rupees as an asset. If you are also in India means you will show 100 rupees as a liability. So if we are consolidating means this 100, that 100 knocked off. Correct? But let's imagine the same scenario. I'm in India. I'm parent. You are subsidiary, but you are in US. And I gave you $100 loan now. $100 is loan. That means can I account it as $100 now, or I'll account it as rupees? I will show it as rupees. Correct? And rupee means now we have to check. So there's a foreign currency transaction. Now we'll have to check whether that foreign currency transaction is a monetary item or non-monetary item. Now you tell me whether loan given to you is a monetary or non-monetary item. It's a monetary item because fixed. If I give you $100 worth of loan, you will repay me $100 only. I'm not talking about interest here. Principal is fixed. Correct? Yes. So that so it's a monetary rate means I have to use closing rate.
Yes.
I will use closing rate and convert it. Correct? That means it is fluctuating. But you are still showing it as dollar. When I consolidate, I have to add. Correct? So there will be some exchange gain or loss that will still remain. Then of that, what you have to do? That gain loss would have already gone to PRL because it's a monetary item. Correct? In consolidated financial statement also, should I show it in P&L or should I show it in OCI is what we are trying to test through this. Understood that? Okay, for that they are saying, first check. You understood what is receivable payable now? Forget about the treatment. We have 2-3 questions based on that. I thought since you asked that question, what is receivable payable, I gave you the whole treatment. No problem. Even if few things have not gone into your mind, no worries. With numbers, we will see. Fine, now we have 2-3 questions. Don't have to worry that at all. And it's been asked also. You understood the meaning of receivable payable now?
Yeah.
Okay. So first you have to check whether that receivable payable, no? Is it recoverable or non-recoverable? Or no intention to recover? No intention to recover. You can check or you can write like that only. Intention to recover or no intention to recover. Like that only you can write. intention to recover, no intention to recover. So what does this mean, sir? You tell me, what does this mean? Every time you only ask question. This time I will only ask you question. What does intention to recover means? Sir, we gave the
loan to the subsidiary and like ask them to keep it, like don't have to repay.
We gave the loan to a subsidiary and said, subsidiary, see, for the time being, I'll give you. After 2 years, please repay. 2 years time for you. Do whatever you want, give me the money back. Correct? If that is the case, means we have an intention to recover the money. If you have intention to recover the money, then in SFS, this is a monetary item, sir. In standalone financial statement, correct? But this is in different currency, correct? So if it's a monetary item, will there be any gain loss? Yes, because initially we would have recorded transaction at transaction date, exchange rate. But monetary item have to be shown because you have not yet received the money. You'll receive it after 2 years. That means that foreign currency will have a balance. That balance, can you show it at transaction date, exchange rate or closing rate? It's a monetary item, you have to show it at closing rate. So transaction date ka exchange rate and closing rate, exchange rate, will it be same or it could be different? Generally will be different. Yes, no. I mean, there'll be gain loss. That gain loss in SFS will go where? To PRL. Correct? No. And gain loss in CFS also will go to PRL. If that is the case means. Okay, now. If you have intention to recover means, then gain loss in both SFS and CFS will go to PRL. So in CFS, how it will come, sir? First of all, what is CFS? Consolidated financial statement. Why will it come in financial statements? Will it come first of all?
It has to come because...
What will not come? The principal portion will get knocked off, correct? But there will be some exchange gain or loss remaining. At exchange gain loss only, I am telling, okay? I am not written the word here, principal. Check, I have written the word gain or loss. Gain or loss on exchange fluctuation only will go to PRL in this case. Yes. If you have an intention to recover. Yes, sir. Yeah, little bit is going at least. So if you have no intention to recover, doesn't matter. In SFS, still it is a monetary item. That gain or loss will go to PRL only.
So if you have no intention to recover, then this equity, no?
What moment? What did you say?
If we have no intention to recover, then we will treat it as equity, no?
Perfect. That is what CFS is telling. If you gave the loan and you're forgetting it, correct? No. Then will you ever recover that money back? No. I understand that, like principal amount of loan you will knock off. For you it's a loan given, for him it's a loan taken. That you knock off. But exchange gain or loss will be there. But are you ever going to recover that exchange gain or loss?
No.
No, never. Because like you have no intention to recover, correct? So is it right in you putting it into P&L now? No, because it is an unrealized gain. Now this unrealized gain, you show it in OCI. And let it be in OCI. Let it be in OCI till you dispose the investment. This is a treatment recommended. Okay? Once you sell, or once you lose the control of subsidiary, then from that OCI you transfer it off to retained earnings, or OCI to P&L, not directly to retained earnings, directly to P&L. This is the intention. Artha aita? And doubt or okay? Yes. So in CFS, what you have to do? If you have no intention to recover, then gain or loss will first go to where? OCI. In OCI, I should write bracket R or NR, sir? OCI, I should write R. Why R? Reclassifiable gains, correct? And then what you will do? On disposal of what, sir? Subsidiary?
Yeah.
Is it necessary you have to dispose of subsidiary fully, sir? Or when will consolidation end? Or on loss of control? Or I can just write LOC. Whenever loss of control happens, then what will happen? Then, right now we are parked that gain or loss in OCI.
Yeah.
Now from OCI it will go. Now is it unrealized gain or it become realized gain for you now? Realized gain. Because you sold the money means even that effectively have recovered. Yes or no? No point in showing that OCI. So transfer it off to PRL in that case. This is all. Okay. Manageable. We gave quite a few things. First we'll be doing only first part of the chart. But thought I can do of this also. Fine. No worries. If you're not still got a little bit of this portion, no problem. This will take it a little later only. But write down nonetheless. Anything specifically you want me to show? This only. Okay.
Yeah.
Okay. Sir, we're not going to be applying this temporarily. Okay. We're going to start slow. We're going to do this first. Then we come to that. My intention of putting everything in one place is on the last day. Fine. Sometimes you'll be referring your notes, correct? So if you have everything in one page, it might be helpful for you to revise. That's what I put it up there. Okay, actually, maybe you have to skip it also because anyway it is there in charts. But once I thought I'll practice so that next when we revise through the charts, you'll know, we have discussed this, we've applied this, so that you'll remember it even much longer. Hence, okay, for the time being, we're going to only concentrate on the conversion aspect. Fine, slow by slow, then we'll move on to this. In fact, this is itself is a summary of your chapter. Next thing is just an extension of this. If foreign is subsidiary, then you say do this, do that. That's all. Same thing only like this. This only itself is a whole topic ka chart, you could say one way. Everything is covered here only. Fine. Rest everything is small bits and pieces. So we'll do a question, or you want to take a break and resume? Your intention depends on your zone. Which zone are you in? So I not like to compel that for you. Break. Okay, break means first we will recap. Because quite a few we learned and quite a few new things. No, so let's have a quick recap. Okay, first what did we learn?
What is foreign currency?
First, IND AS 21 ka main gist is what? It covers if you have any foreign currency transactions, not a subsidiary, just a regular foreign currency transaction, what you should do. Correct? And if you have any foreign operations, what you should do. This is what it covers. Correct? Then we look at the definition. Definition means we thought three types of currency: functional currency, foreign currency, presentation currency. Foreign currency means what? Have they defined or they told something? They told. Foreign currency means that currency which is not a functional currency. And they defined functional currency. Functional currency means what? It's a currency of primary economic environment under which a company operates. In which environment do you operate? That country ka or that environment ka currency becomes your functional currency. Why is functional currency important? Because we measure assets, liability, income, expense, equity and all at using the functional currency as a basis. Yes. And how to find out functional currency? They gave you four indicators, not a condition, indicator. Two primary indicators, two secondary indicators. Two primary indicators are: first, check in which currency are you billing. Your sales is denoted in which currency. And also check what is the influencing factor for determining that price. Which country ka competitive forces and regulation helps you determine that sale price. Check that. Okay. Second one, check in which currency are you incurring the cost. You have to give goods or service. You have to give to provide for that goods or service. You will be incurring cost. Check which currency are you incurring that cost. Okay. These two are primary indicators. Next one will be check in which currency are you taking the funds. You're doing funding in which currency. Financing currency basically. Next you check in which currency are you retaining operation receipts. When you are doing operations, you'll get some money, Check in which currency are you retaining that. Meaning in a way, in which currency are you investing that. Okay. So investment currency. All the conditions should be satisfied. First of all, it is not even a condition. It's just an indicator. Case to case basis, you will have to take a call and say which has a trump over the other and conclude. Yes, no. Then we saw reporting entity and foreign operations. Or rather, like in a third type of currency is presentation currency. Presentation currency means the currency in which you are presenting your financial statements. If you are in India, you have to present financial statements obviously in INR. Does it mean your functional currency is also INR? Not necessarily. You might be in India, but your mind might be in, that's what our teachers used to say, physically present, mentally absent. That whole scenario is apt for India 21. Okay. Physically in India, but our mind is in dollar or some other currency. Correct? So it could be the case. Then we saw what is foreign operations. Foreign operations means what? It could be either a branch or a subsidiary or a JV or an associate. Okay, whose activities are conducted either in a country other than that of reporting entity or in a currency other than that of reporting entity. As a general rule, thumb rule is one entity, one functional currency. But if you have a branch, maybe the thumb rule could be broken. Fair enough, because even same entity got two branches are having different functional currency. In that case, what to do? You have to analyze the facts and determine one functional currency and present them as one. Okay, now. Anyways, that functional currency over. Then what did we learn, sir? Then we saw reporting entity and foreign operations. We said there are factors in, if you have to check whether reporting entity and foreign operations are one and the same or are they different entities. One and the same, andre? Legally they may be different, but in practice, foreign operation is just an extension of the reporting entity. Correct? Meaning we're trying to find out whether reporting entity and foreign operation are having the same functional currency. There were four factors or indicators for that. They said one, check how is that foreign operation being conducted. Does it have significant authority? Can it run independently or are they dependent? Fair enough. So if they are done as an extension of reporting entity, then what? Then it looks like functional currency for both the entities are same. Correct? No. Second, we saw what? High degree of dependence, high volume of transaction. Reporting entity and foreign operation, if they're having high volume of transaction, again there is an indicator that they're dependent on each other. Hence they'll have same functional currency. Yes. Third is what? Cash flow. If foreign operation is generating doing operation means they will generate cash flow. Correct? If they are remitting that cash flow periodically, full cash flow periodically, then it looks like what? Like what? They are dependent on these guys. Yes. So these guys are helping them out with something. So it again indicated that both functional currency is same. Last, the foreign operation activities ka cash flow is not sufficient to pay off their debt obligation. So they are dependent on the reporting entity for that. So if these indicators are present, means you can conclude both ka functional currency is same. Otherwise could be different. Those are the ones. Then we looked at conversion. So if you have any foreign currency transaction, then first you have to check what is the nature of that foreign currency transaction. Whether it's a monetary item or a non-monetary item. Monetary item means whose value is fixed, expressible in fixed denominations of currency. Non-monetary means whose value fluctuates. Examples of monetary and non-monetary we saw. Yes. So whether it is monetary or non-monetary doesn't matter. On the transaction date, everything is recorded using exchange rate on the date of transaction. That's what we call it as transaction date ka spot rate. Yes or no? Initial recording will happen at transaction date ka spot rate. Settlement will happen at settlement date ka spot rate. But between this transaction and settlement, no. If balance sheet comes off in between, then you have to show at what value should I show that those items. For that, you have, for disclosure per se, first you have to know whether that item, that foreign currency balance is a monetary item or a non-monetary item. If it's a monetary item, they said use closing rate. If initially you used a transaction date, now they're saying restated at closing rate. So there will be some gain or loss. And gain or loss straight away goes off to PRL or SPL. Yes. If it's a non-monetary item could be valued either at cost or on fair value basis. If it is valued at cost, no need to restate. Initially you already converted using transaction spot rate. Show the same value in balance sheet. If you are using the same means, will any gain or loss come? No gain or loss will come. Suppose you are valuing this non-monetary item at fair value. Initially you recorded a transaction spot rate. Later if you find the fair value, now what you have to do? You have to check on which day did you find out the fair value and use this exchange rate available on the fair value date. Yes, no? So since exchange rate is different now, there will be some gain or loss. That gain or loss will be as per respective IND AS. If that IND AS says that gain or loss should go to OCI means, it will go to OCI. Otherwise, if it says P&L means it will go off to P&L. Both the possibilities are available there. Yes, no? This is for normal conversion. Then we saw one extra topic like net investment in foreign operation. If you made any investment, that's what you have to do. Fine. So normally valuation basis in SFS will be what? Either you can go for cost basis or a fair value basis. If you're valuing at cost basis, no problem. Correct? Then what? Use it. It's a non-monetary item any which way. It's like non-monetary item valued at cost. What you will do for that? Use. Anyway, you already converted a transaction date spot rate. Use the same. No gain or loss will come. Suppose you are valuing the investment at fair value basis. Now, non-monetary item is valued at fair value basis means what will happen? There will be some gain or loss. Correct? To find out that gain or loss, first you have to use exchange rate. On which date? No. Not on transaction date, but on the day on which you found out the fair value. Correct? No. That's what we have written as exchange rate on the fair value date. Now this gain or loss. If you're following FV TPL method, it will go off to P&L. Otherwise, it may go off to FV OCA. Yes, no. Then you also investment in net investment in foreign operation means the meaning is you are interested in net assets of foreign operation. Correct? Hence we only considered investments, equity shares. So if you invested in debentures and all, you invested in debentures, but those debentures are classified as equity means, then you apply the same provisions. Correct? If those debentures are classified as financial liability means, then you don't apply this. There's something else we'll do for that. Okay? Now if you have any receivable payable transaction, like loan given, loan taken. Loan given, loan taken, when you do consolidated financial statement will get knocked off. Correct? Now for one company it will be an asset, another company it will be liability. But both these companies are not in the same country. They are in different country means they are using different currency. They're using different currency means when converting there will be some gain or loss. So principal portion will get knocked off, but the gain loss will still remain. That gain or loss what you have to check. So before you check the treatment for that gain or loss, first you have to check whether you have an intention to recover. Not the actual recoverability, but the intention to recover. If intention to recover is there means both in SFS and CFS will go to PRL. In SFS, it has to go to PRL only. Yes, no? Because this is a monetary item. Loan given. Receivable means a loan given or loan taken. All these are monetary items, no? Monetary item ka gain loss will go to PRL only. Yes? But however, if you don't have any intention to recover, you gave the loan, you don't have any intention to recover, means this exchange loss is a realizable gain now or unrealizable gain?
Now it is unrealizable.
So in CFS, you will treat it as gain or loss to OCI. Correct? But in SFS, since it's a monetary item, correct? You're supposed to follow the same principle. Hence, gain or loss will go to PRL only. Only in CFS, when you're consolidating, that gain or loss will remain and that will be transferred to OCI temporarily. These are reclassifiable. Once you sell off that subsidiary or once you lose that control over that, then from OCI it will move off to PRL. That's it. Okay. Alright, let's take a break and then we will apply all this in our whatever problems that we have is remaining. Fine. Thank you.